I think what we saw in this Sunday presentation by Scott Bessent on CNN, State of the Union, was marking to market or making, publicly acknowledged what the Treasury watchers behind the scenes had already kind of snuffed out as a policy pivot. When we get there, we'll talk about the long bond on the channel. Well, I'll start here with this quote on CNN. It's just a tweet. I have no idea this account, Election Wizard. Who cares? Not promoting them whatsoever. This was just one of the highest viewed tweets, X posts, whatever we're calling them now, on this interview Sunday. But the key thing Scott Bessent said was, we are going to grow the GDP faster than the debt's growth, and that will stabilize debt to GDP. He calls that the most important number. So when we say debt to GDP, they're talking about sovereign debt, the U.S. debt, so 130%, 120% roughly where we're at. And the idea is, hey, can you term it out? The answer there is no. And what this is acknowledging is we're going to need to run it hot. We're going to need to grow that GDP number, the denominator, faster than we're growing the debt. How do you do that? Well, GDP encompasses private sector, right? 2/3 of GDP roughly is consumer spending, consumption. Another large chunk of that is businesses, fixed investment, et cetera. And then you get government, and then you get a portion for net exports. So what he's saying here is we're going to run nominal GDP hot. And to do that, you need to get the consumer and businesses expanding their balance sheets, right? How do you do that? It's going to have to come, you're going to have to kickstart growth up so you can take some real growth enhancing policies. I'd argue to some degree the tariffs would do that as you shift towards domestically produced goods and services as opposed to international or foreign imports. That's what the tariffs do. But the idea here now is like, we're going to incentivize credit creation, run it hot. And so what you're seeing is, if this is like saying the quiet part out loud on Sunday, and now the markets are coming into that acknowledgement. You get into the Treasury curve. We've talked about this channel where this is the long bond in its price chart. This is the highest duration, thinnest coupon long-term Treasury bond that's ever been issued. It was the May of 2020, back at the lows of ZIRP and COVID, QE stimulus, all of that. These bonds have been, I guess you call them a disaster for the bondholder here since they were issued. They're down 55% now in terms of just losses on the bond. They trade at 45 cents on the dollar. But then you factor in with inflation, these things have just been rinsed. But the point is, over here, you can see in the blue lines the channel going back to early 2023, where we've been in an upward sloping, I'd call it a bullish trend. It's not very strong, but you saw some stability come into the long-term interest rates and the Treasury market, right? And it hasn't been low volatility per se, right? You're bouncing off of those bands in the channel a couple of times on each side, but we've been talking about, very attentively, watch this channel. Either, when we started the quarter in April, Liberation Day, we saw the rally into Treasuries, which has been immediately sold. But we've been talking every week, watch for this channel. Every time it's threatened to break on the low end, that's a risk. Or, what we'd be looking for if you're a believer in the, I guess, recession classic thesis, the 1980 to 2020 style recession, where you get long-term rates coming down, heading into recession fears, flight to quality, real growth expectations slow, inflation slows, bond yields come down, bond prices rally. We've got the opposite here. Treasury broke earlier this week. I've got it circled in two little highlights with red and yellow highlighting. We first broke the channel on Monday, and we'd already threatened it twice this year, right? The April 9th, heading into the teeth of Liberation Day, where we were forced to call it off. Remember that? Matt, Dave, and Cameron's kind of infamous Hagler versus Hearns weekly roundup episode. And we also saw it in January, just before the Trump administration, was sworn in and took the handover of the keys to the White House. But this is a very clear break. We're out of channel from a technical standpoint. And so what this is responding to, this is the market acknowledging the bears have won after, Bessent goes on, the Sunday talk shows, tells them the new policy improvisation, a pivot, if you will. And you've even seen it at this point with the black dashed line, where you've got two prior support tests of lower lows, right? Going back to April 2024 and January this year. We've broken through that line as well. So if you think about this from a technical standpoint, what is trend now? Trend is very clearly long-term Treasury rates do not look like they're coming in. They want to rise. And that is all stemming from this, we're going to grow nominal GDP faster than we grow the debt. How do you do that? You have to incentivize the private sector to expand their balance sheets, households and businesses.
And Matt, I think it's worth mentioning too that this is happening globally on long yields globally, right?
Not so the countries, but I don't have this slide. But if you look at world bond markets, the countries who are hitting 52-week highs right now, or yesterday technically, rates rallied a bit today, not much, but they did come in. 52-week highs on yields were hit yesterday in the US, Canada, UK, Australia, New Zealand, and Japan. And that's out of the top 15 to 20 economies. What do those things have in common? Right? We have this theme that's well established now, going back probably 10 years. We're out of the unipolar world, post fall of the Berlin Wall. Soviet Union collapses. Now you've got the U.S. centric order. That is all kind of fragmented now. You've got the regionalization. And so I think what you're seeing here with the 52-week highs hitting that specific group of sovereigns across the board, what do they have in common? You got the Commonwealth countries operating out of the UK. You've got the UK attaching itself with the first real trade deal locked on with the US. And these deals or arrangement, they're not fleshed out to the point of like USMCA or NAFTA 2.0 type of these things take a few years to put together. The first one though, the UK trade deal light maybe, an MOU, memorandum of understanding trade deal type of situation. UK is the first one to come along and plug in with the US and play, okay, we're simpatico. And then Japan as well. Japan is kind of your most trustworthy ally in Southeast Asia, if you're the United States. Ever since the two of them made peace post World War II, fought it out, came to a conclusion. Japan's been, a very good friend of the United States, running in lockstep. So you see that kind of band coming together of those Commonwealth countries, and I think that's a signal of who's letting their interest rate markets, the long-term yields increase, and adopt this policy front of we're going to run it hot, high nominal growth, which means higher inflation expectations, which normally the definition of that for most people who are viewing this, I think it's become kind of the non-monetarist definition, but they think of inflation as rising prices. Talking about both here, this if this policy that Bessent said is the new path, if this works, it's going to require monetary inflation, which means balance sheet expansion. And some of that is going to have to come through the financial sector as an intermediary, both regulated and unregulated within the domestic U.S. But then it's also going to require balance sheet expansion from households and businesses as well. And then the idea is that rate of growth is high enough that you can tuck the rate of growth in debt into it, right? And so you kickstart the economy, run it hot, and grow that way. Now, who is this worse for? It's worse for the bondholder. This is not a good thing. So if you look at this chart, the black line, kind of right now, the way I'd be operating, that looks like your new, like your trend line. And I think we're headed to spend some time below that line. In the weeks ahead, we'll keep watching this week after week, but we should start to get a clearer sign of yield levels.